This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Chapter 27 deals with forecasting techniques, and this is substantially one of the topics which has been brought forward from paper F5. You may therefore not need to spend very long on this chapter, but if you need more information, I suggest you go back to the F5 lectures. There are 4 topics we'll be looking at. First of all, linear regression and the coefficients of correlation. Then there'll be time series analyses using moving averages, expected values in decision trees, and finally, scenario planning. At this level, you will in general not have to be doing very detailed calculations. For example, on linear regression, you are much more likely to be given the results of somebody else's calculation and maybe to be asked the potential problems with these sort of calculations, where you need to be careful how they can be used, essentially to predict or to forecast what might be happening in the future. Okay, so we'll deal first here with looking at linear regression. And linear regression is a method of fitting the best straight line possible through a set of points on a graph. Sometimes those points very obviously will line up so that the line can almost be exactly placed all the way through each of these points. Sometimes these points will be widely scattered over the graph, and you can know almost by looking at it that it's almost a waste of time trying to fit a straight line through it. But linear regression will nevertheless fit the best straight line it can through those points. So if you had a graph of, say, somebody's age or their birthday from 1 to 365, the days of the year, and the last 3 digits of the mobile phone number, and you graph that out, born day 79, last 3 digits of the phone number 321, you could obviously see that's going to go all over the place on the graph. There is no relationship, but linear regression will purport to say, well, this is the best relationship I can get from that. But of course, you wouldn't expect to put any sort of predictive power within it. Usually you have more idea that there is a relationship between the 2 variables, really. So as you increase the production volume, you'd expect the cost to go up. As you increase the selling price, you'd expect the sales volume to go down. As you increase the hours worked by your workforce, you'd expect the units produced to go up. And what you end up with, what the linear regression is going to give us, it's going to give us a line in this relationship. This is a straight line here, where y is the dependent variable. So if, for example, you were looking at cost and production volume, then cost would be this one, and x is the independent variable, that would be the volume. So what you're really saying is, I'm deciding on what volume I want to produce, and this will determine what the cost is going to be. So the cost is dependent on the volume. B here is a value, so if you produce nothing, B is going to essentially still be a value. So in general, this graph is going to look like this. So if you had your volume going out here and your costs going up here, it's going to be going like that. And this amount here, this is the B in here, this is the cost you're left with if the x was 0. And then it's going to go up here. The slope of this here is A. Every extra unit you make is causing an extra cost of an amount A. Obviously, by plugging in any volume you like, you can come out with a prediction of the cost, but we need to be just a little bit careful about that. Where you need to exercise some caution are in the following areas. First of all, as I said at the start, you could put in the day of your birthday and your mobile phone number, and linear regression would come out with what are purported to be a straight line relationship. You have to test that. And that's done by the coefficient of correlation R, or R squared, which is a coefficient of determination. So if you had R as 0.8, then obviously R squared is going to be 0.64. And that means that 64% of one variable can be explained by the variation in the other. So 64%, say, of the change in cost can be explained satisfactorily by the change in volume. It means that 36% of the change in cost is from other factors. Perhaps it's the commodity price going up and down. Perhaps it's just the weather, that the cost in the factory goes up because you have to heat it more in cold weather. But it hasn't been related to the cost of production. Obviously, the higher R and R squared are, the better. So if R was up at about 0.9, then 81% of the variation in cost can be explained by the variation in volume. We're going to get much more confidence. R can range from -1 to +1. If R is -1, that is perfect negative correlation. That would be a line going like that. As one variable increases, the other one decreases. This could be the volume you're selling versus the price you're charging. It'll go through 0, and if you're through 0, you've essentially got points all over the place like this. There is essentially no obvious relationship. To R's +1, which is perfect positive correlation, where everything's again going to fit exactly on the line really here. That could be the volume produced and the cost which is being caused by that. If you perform your linear regression with very few points, then you've got very little evidence that the answer is worth much. But broadly speaking, if you've got 2 points, cost and volume, any idiot can put a straight line through that. But if you had 20 points lining up almost perfectly, and you put a straight line through that, you've obviously got much more confidence that the relationship you've come out with is worth relying on. Other known influences, I beg your pardon, extrapolation is, I better put a bullet point in here. Extrapolation can be a little bit dangerous. Now, what extrapolation means is going outside the area which you've actually explored. So if, for example, we had a graph here and we had 4 readings, all beautifully on a straight line, and it was looking at volume, it was looking at cost, and you're asked to predict what the cost would be out there, then all linear regression can do is to assume that this line is going to continue. And really, we have no evidence at all that the line will do that at high levels of production. The line might actually go up like that because of inefficiencies of scale, or it might actually begin to tail off a little bit because of efficiencies of scale. So once you begin extrapolating, going outside where you've actually got experimental evidence, you're in a bit of a no man's land. Interpolation is fitting in the gaps really here. So if you're asked to predict what the cost would be at that volume, you're kind of going in between these 2 points. That's going to be much safer. Other known influences, such as inflation, should be removed before you do your analysis. So if you had cost and volume from the last 5 years, then of course, as well as the volume influencing the cost, inflation or commodity prices are going to be influencing the cost. And what we need to do is to try to get rid of these known influences. So what you could do is you could kind of inflate all of these costs up to current amounts and then do your linear regression. And finally, even good correlation does not prove cause and effect. So you could have an advertising director who says, look, I've been increasing my advertising, and every year I increase my advertising, the sales volume goes up. And it says, very good correlation, therefore advertising must cause sales. And it may be plausible, but the good correlation doesn't tell you that, doesn't prove that. Sales could simply be going up because the economy happens to be improving as well as the advertising expenditure. So just be cautious on that as well. Now, linear regression is very good if you want a straight line answer. What happens if you don't want a straight line answer, or you think it's inappropriate? And this is where time series analyses can come in. So a time series is going to be mapping time against the x-axis. And for example, it could be dealing here with maybe sales, like that. And here basically what we have, this line, it's going up in a very regular fashion, but it's obviously going up. You can see in here what is called a trend. You can see behind the ups and downs of the line itself, there's an underlying increase in the sales as you go forward. But then superimposed in that, there are seasonal variations. So perhaps every summer, let's say it's the sales of certain types of clothing, every summer the sales hit a high spot. Every winter the sales are going to be hitting a low spot. And seasonal variations are regular variations with a cycle length of less than a year. It could be sales in a day. So perhaps at the weekend the sales are always going to be high, on a Monday they're always going to be low, and so on. And you could be plotting this maybe over 5 or 6 days a week, up and down, up and down, up and down. But that will be a seasonal variation as well. And what we'll be trying to do in this sort of analysis is to isolate what the trend is, so we can kind of predict maybe where that trend is going to go. And then we say, well, what season are we going to be in? And then on that trend, you kind of superimpose the seasonal variation to say, what are the sales going to be this summer 2 years away? There are two other components just to be aware of that can make variations in sales or whatever. One is a cyclical variation. This is a variation with a period of longer than 1 year. Something like an economic cycle is typically maybe a dozen years, slow increase and decrease almost worldwide in what economies are doing. We don't get into that, it's too slow to worry about. And then there are always random variations around the place, which almost by definition you can't deal with. So it could just be an excessively long and cold winter is going to make certain variations, but there's no way we're going to be able to predict that, so we don't even try. So we're going to be concentrating on trying to find the trend and the seasonal variations. So here we have a very quick little example here. What we've got in the first two columns is what I would call the raw data. We have got 4 years, 1, 2, or 3 years, and in each year we have 4 seasons, 1, 2, 3, 4, 1, 2, 3, 4, 1, 2, 3, 4. So we've got 3 years worth, we've got 12 readings in here. And you can see the sales go wild. We've got very high 4,800 there. And then it's less than half down there. And then it kind of come up again in season 3. And then it goes way down again in season 4. These sales are kind of all over the place. And they may have within them a trend that can be discerned and seasonal variations that are worth investigating. And that's what we're trying to do. Get rid of these gross ups and downs and try to see some pattern to the data. So the first step in this, if we think there are 4 seasons, is to take what's called a 4-part moving average. So here we have season 1, season 2, season 3, season 4. And we average those out and we get this here, 2975. And then what you do is you move down 1 season. So we then take season 2, season 3, season 4 and season 1 and we average them out and we get that figure. And we do it again, each time moving down 1 season. But every time you just move down 1 season, you've always got a representative of season 1, season 2, season 3, season 4 in the average. And the idea is that you are smoothing out the very high, maybe season 1, and the very low season 4. You're getting rid of these ups and downs by always having the 4 components in there. So we progress on down there. So the last one here would be this 1920, 2160, 2832, 2520, averaged out to 2358. Now the problem with these is if you have an even number of seasons and you average them, and strictly speaking the average is right in between them there. It's not really lining up with any particular season. So what we do is essentially take 2 averages and you average them out, and then you're going to be opposite a season. So what we've done next is you take these 2 here and you average them. So this here, you can see just physically, you can see this is going to be averaged out as a Q3 figure. And then you go down and you take it 2 more. 2490 is going to be your average 4, and so on like that. So what we're getting in here is what's called a centered moving average. It means you've lined it up in one of the seasons. And this is the trend. So the 8-part centered moving average in this example is the trend. It's not perfect, it's not going exactly here. In this case it's going down essentially, starting at 2720 at the top, down to 2451 at the bottom. It goes up and down a little bit, but I think just by looking at it you will see that it is substantially smoother than the raw data. What we then do is to look at individual seasons and see how the actual results compares to the trend. So the actual result for season 3, year 1 was 2,400. The trend figure said 2,720. So we're in a way minus 320 in here. This seems to be a poor season. The actual figure is much lower than the trend. We go down the next one. We have the actual figure 2,500, 2,490. We're nearly on the right spot there. There's a very small seasonal variation of +10, hardly worth bothering about really. We go to the next one, 2,760, 2,590. That looks like a good season. Yeah, we're well above on that one. This seems to be quite a kind of successful selling season and so on. So you go down to that and you're getting all of these seasonal variations for all of the seasons whose results we have now, and then you collate them together over here. So you bring together all the Q1 seasonal variations, all the Q2, Q3, Q4 seasonal variations, and you average them. So this here is just the average seasonal variation. Now that almost certainly, this calculation would all be done for you in the exam. The examiner is not interested in you going down doing 4-part averages, 8-part averages and so on. You're well above that now. The examiner will give you this and ask you to make use of it. Okay, and typically the use you're going to be making of it is to say to predict what the sales are going to be, maybe in, let's say, Q2 for year 4, because this allows us then to plan. So how do we do it? We need to predict 2 things. We need to predict the trend, and we need then to superimpose on that the seasonal variation. First of all, the trend figure. Well, we have got from 2720 all the way down to 2451, and we've done that in 7 jumps. So 1, 2, 3, 4, 5, 6, 7. So we can work out we've gone from 2720 to 2451 in 7 jumps. The trend figure is about minus 38 per season. The prevailing pattern of sales here is going down at about 38 per season. So we want to predict the sales in Q2 for year 4. We will start with the latest trend figure we have, and then we're going to be going 1, 2, and then to season 1, and then to season 2. We want to be going 4 jumps ahead, 4 seasons ahead. So what we're going to be having here is 2451, and then we're going to be losing sales at this rate, 38.4, for 4 seasons. So that predicts what the trend is going to be. And then we say, aha, yes, but season 2, is season 2 a good season or a bad season? What's the seasonal variation? And our calculation implied that it was 96 positive. So we will increase the predicted trend figure, we'll increase the predicted figure from the trend by 96 and come up to 2393 as the prediction, seasonally adjusted prediction for the sales in Q2 of year 4. This can be a fiddly calculation. I mean, one of the problems particularly is that because there's 2451 here, it's got 8 figures in it. Really, it's an 8-part moving average. So it's 1, 2, 3, 4, 5, 6, 7, 8. It's got all of these 8 figures in it. Really, we have. It lags. You know what I mean? It's got a lot of historical kind of data within it there, and I'm sorry, it doesn't go back as far as that. It goes back to it goes back to there. Okay, but it's bringing in figures here from maybe quite a while ago, and this method can be a bit slow at picking up changes in the trend because you're waiting in some very historical sort of data. The next example, the next technique to look at is that of expected values here. And here's where we use probabilities and different outcomes. So here we have 2 projects. Let's look at project 1. And we have 2 potential outcomes. It could be, state of the world 1, state of the world 2, economy 1, economy 2, depending how things go. And the forecasters have said they're equally likely, so a 0.5 and a 0.5 in here. And the income could be 1,000 or 11,000. So we don't know what we're going to be getting, but expected values, what it does is it weights the outcomes with the probabilities. So it says there's a 0.5 chance of getting 1,000, so that times that equals that. And a 0.5 chance of getting 11,000, so that times that equals that. And you add it up and you get an expected value. Similarly, if we tried project 2, 0.5 chance of getting 5,000, 0.5 chance of getting 7,000, expected values of 6,000. So here we have 2 projects with the same expected values, really. And this would imply you can't decide between them. And this is where we can really highlight maybe 1 or 2 of the major problems with expected values here. First of all, for once-off projects or once-off strategies, the expected value is normally not actually expected. If we take on project 1, we either expect 1,000 or 11,000. We have never predicted getting 6,000. Similarly, if we take on project 2, we're either going to get 2,500 or 3,500. We've never dreamt of actually getting 6,000. So it maybe seems a little bit peculiar basing decisions on values which will never arise. Secondly, expected values does not take into account the idea of risk. So let's say the cost of these projects, the costs were the same, was going to be 4,000. If I undertake project 1, it's predicting expected value 6,000. It's kind of saying, expected net value is going to be 6 minus 4 is going to be 2,000. But there's a 50-50 chance that actually I spend 4 and only get 1. It's a 50% chance I lose 3,000. And that could be absolutely deadly to the company. Maybe it couldn't sustain that sort of a loss. Whereas if I spent 4,000 in project 2, there is absolutely no possibility, as far as I can see, of actually losing any money. The worst I will make is 5,000. The worst net profit I'm going to make is 1,000. And expected values hasn't taken this risk into account. And I could easily have, changed the figures slightly, so this here could have come out at 6,200. And you might be saying, oh yes, go for project 1. Project 1's got a higher expected value, it's better. But it's not better, maybe not better, if you look at the risk, if you look at particularly the downside risk. An expected value doesn't take that into account. The final potential problem I put in here really, it's not listed here, but how on earth do people arrive at these probabilities of 0.5? How do we know it's not 0.4 and 0.6 or 0.25 and 0.75 and so on? It must be really, really difficult to predict what exchange rates are going to do, who's going to get in the new election, whatever is affecting the states of the world. And we always have to be just a little bit suspect of putting too much belief in the figures which come out of these calculations. Now, where you have several calculations or several probabilities happening, one after the other, then what you need is a decision tree. And a decision tree is just simply a diagrammatic way of setting out when you make decisions and when you are, in a way, the hands of fate. So there are two types of symbol on the decision tree. First of all is a decision point, and you can choose, I will do that or I will do that. Or secondly, there's a chance point, and in the chance point you're in the hands of probability, the hands of luck, if you like. The probabilities coming out of that is always going to be 1. You have to wait and see, but you've got no power really to influence it. So let's just work through this little example. Project initially is going to cost 5 million. And income for the first year will either be 3 million with a probability of 0.6 or 2 million with a probability of 0.4. At the end of the second year, we could upgrade a decision. We could upgrade for 2.5 million, and then income would either be 6 million with a probability of 0.7 or 3 million with a probability of 0.3. If we don't upgrade, we will get exactly the same income for year 2. And I think this should say really for the second year, at the end of the first year, okay. So rather than at the end of the second year, we'll say at the end of the first year, okay. So first year is going to be 5 million or 3 million. Second year we can upgrade or not upgrade is basically what's going to be happening. So let's see how this would be set out on the diagram. So we're going to be starting at the left and moving forward. You move forward on a kind of time basis. What's happening next? What can I decide next? What do I have to wait to see? And the A, B, C, D in here, they're just ways of labeling it, okay? So now I have a decision to make. I can do nothing, or I can spend 5 million. If I spend 5 million, I'm then waiting for the year 1 results, and they occurred with certain probabilities. There's a probability in here of high income of 3 million, and the probability was 0.3. If you go back to here, 3 million is the probability of 0.6, or 2 million is the probability of 0.4. And this is the end of my kind of first year here, and I'm thinking now of embarking on my second year. And here's where I can make a decision: upgrade or don't upgrade. If I don't upgrade, we're told the results in the second year will be the same as the first year. So we're going to get 3 million for sure, or we're going to get 2 million for sure in there as well. Or I can upgrade, and if I upgrade, I'm spending in both cases an extra 2.5 million. And then again, I'm in the hands of fate. I upgrade, I start trading in year 2, and the scenario said back here, we're going to get upgrade for 2.5 million, would then be 6 million with a probability of 0.7, 3 million with a probability of 0.3. So 6 million, the probability of 0.7, 3 with 0.3 in both cases, okay? And that's a diagram formed. And then what you do is you move back slowly, sometimes called roll back, going to each junction by each junction and seeing what's possible there. Okay? So let's look at E here. E is a chance point. We're in the hands of fate, if you like. We have to use expected values. A 0.7 chance we get 6, a 0.3 chance we get 3. So at E, it's 0.7 times 6, 0.3 times 3, it's 5.1. I think you can see it's going to be exactly the same at F here, because we have exactly the same figures coming out here. Expected value at F is exactly 5.1. And really what this does is to say instead of looking what's actually happening further up the line here, we're really getting rid of all of this, okay? It's all been simplified down to that. Let's go back to point C, where we have a decision to make. And we can decide to do no upgrades, and obviously we would get 3 million. Or we could upgrade, and we would get 5.1 less 2.5 in there. We're only going to get 2.6, aren't we? So the value at C is 5.1 minus 2.5, 2.6, or 3. And obviously 3 is better. We would decide, you don't want to go up there, you want to upgrade. 3 million is better than 2.6. Similarly, when you go back from F back to D here, again, we can be getting 2.6 if you upgrade. That's exactly the same figure, 5.1 less 2.5. Or we can be getting income of only 2 million. So our choice at point D is 2.6 through the upgrade, or 2 million by doing nothing. And obviously what we would do is you would decide to upgrade. So really what we've got back here is we're saying at point C we can see 3 million, and at point D we can see 2.6 million. And really all of this is now gone. It's all been simplified back. And finally we get back to B. And B, there's a 0.6 chance that we take the upper route here. But here's where you need to be a little bit careful. Be careful. That 0.6 governs getting 3 million in year 1 and then 3 million later on from the year 2 investment. And similarly, if we went down this lower route, there's a 0.4 chance that's going to be taken up, but that's going to govern getting 2 million there and 2.6 there. Okay, so everything up this route, either immediately or further up it, is governed by the probability of that route actually happening. So at B, it's 0.6 times 3 plus 3. Okay, year 1 plus the year 2. And then 0.4 times 2 plus 2.6 going to give us 5.44. So what we're faced with here is 5.44. So back to A now. We could do nothing, make nothing, lose nothing, or we could invest 5 million for the hope of 5.44 million. So 0.44 would be the net income coming from that. Therefore, invest. This is going to say invest. Getting 0.44 is better than getting nothing. But remember, risk. We could invest 5 million, and what could have happened is you only get 2 million in year 1. And then what might happen actually up here is we invest another 2.5 million, and we're only going to get 3 million in here. In year 2, we could be, really having a very rough ride there. We could actually be making a loss if the worst things actually happened. So risk hasn't been taken into account again in this decision tree. Decision trees have been reasonably popular in the P3 exam. Reasonably popular. So it's worth you making sure you can kind of draw it and solve it. It hasn't been any more complicated than this. And finally, we look at scenario planning. Scenario planning is really a simplification process. For example, if you were planning for the future and you were worried about the dollar rate, the dollar sterling rate, for example, could maybe be 1.5 or maybe 1.8. And also important is interest rates could maybe be 2% or 5%. And also maybe you worry about political stability, could be good or bad. And maybe you worry about economic progress, could be good or bad. So we've got 4 variables there. The exchange rate, the interest rates, political stability, and the economic outlook. And if they can each be good or bad, you have got 8 permutations. You have got, I beg pardon, you've got 16 permutations. You've got 2 raised to the power of 4. So 16 possible patterns of outcome, good interest, good exchange rate, bad politics, bad economy, good interest, good exchange rates, bad politics, good economy, and so on. And how are you going to deal with 16 permutations? What are you going to conclude from that? And the answer is you can't. So what we need to do is to try to simplify down. And what a scenario planning does, it tries to build a number of believable alternative futures. So here we have a little example with just 2 possibilities. Let's say an election is coming up. You could have government 1 or government 2, and they may have got different public spending plans and so on, which is maybe going to influence you. And interest rates could be 3% or 7%, maybe depending what world interest rates do or what the government decides to do in particular. And in theory, there are 4 possibilities there. Government 1, interest rates 3 and 7. Government 2, interest rates 3 and 7. But what you could do is to say, right, looking at government 1, if it gets in, it's almost certainly going to be raising interest. It's going to be a bit of a fierce government in terms of money control. So that is a believable scenario. It's not worth looking at government 1 and 3%. Similarly, we say if government 2 gets in, it's got a different kind of economic outlook. It'll say, I want to keep interest rates low. It wants to stimulate the economy, whatever it wants to do. So that is a plausible scenario there. And what you do now is you say, well, what would happen in scenario 1, government 1, 7%, and scenario 2, government 2 and 3%. It's reduced your 4 down to 2 scenarios, which is a much more manageable number of scenarios to worry about.